Hey guys, I was actually going to talk about something totally different today, but I actually saw this article in the Wall Street Journal, and we were all talking here in the office about this, and I thought, I'd just hit a little different topic today. Article in the Wall Street Journal says stocks surge as China calms jitters. Now, here what was going on, stock market, the Dow went up about 285 points today, and the opening of this article says that U.S. stocks rose sharply on Thursday after the Chinese government reassured the market that it remains a committed investor in European assets. In particular, what we're talking about here is the euro. And it's kind of amusing to me in a way. If you think about it, it wasn't that long ago that we were all concerned and all worried about that China would pull from dollar-denominated assets, that they were going to yank on dollar-denominated assets. They were talking about this in the Wall Street Journal this morning and talking about how, it looks like the market's going to rally today because China is actually showing that they're not going to bail on the euro. Well, in principle, what China is doing and what they have been doing for quite a while is diversifying. It's a very basic tenet of investing that we always teach here. They've been diversifying between euro-denominated assets and dollar-denominated assets and in stock market denominated assets. Why? Because, well, China is a net, as far as it goes for trade, they are a net beneficiary of trade around the world. In other words, they export more things than they import, and therefore what happens is they have a trade surplus. They make more money by sending stuff overseas than they actually take in, so they've got to do something with that money. And they have to invest it to make sure that, that the balance of trade, it's just the way it works. And I was thinking about this in terms of individual investors. As an individual investor, a lot of people that don't know a lot about investing think that they're actually protecting themselves and their portfolios when they take their money out of stocks and they put them in fixed income investments, let's say CDs or money market accounts or something like that. And I always am quick to point out that you're not protecting yourselves. You actually have a lot of danger when you do that. There's a lot of risk in putting your money all in fixed income accounts and CDs because you have inflation risk. But you also have currency risk. And that's really the thing that China, as a country, recognizes all too well. In other words, if a currency goes down in value, what's to protect you? As American investors, when we are investing in these fixed income assets, that's what we've got. We've got a lot of currency risk when it really gets down to it. Now, how do we protect ourselves as investors? Or how do we as advisors protect you against that type of thing? Well, one of the things we do is we make sure that you are very well diversified in different fixed income assets all around the world, but we also make sure that you have assets in other companies of other countries all around the world. By doing that, what happens is we automatically have a built-in protection against currency devaluation. So, hey, if one of the major global superpowers, one of the major countries around the world is smart enough to protect themselves against currency risk, maybe we ought to be smart enough as well. We'll catch you next time.